Welcome to Kaplan Professional's monthly economic update. I'm Andrea Booth. Today we're talking to the Managing Director of Market Economics, Stephen Koukoulas, about everything from Australia's falling house prices to the trade tensions between the US and China. Stephen, welcome.
It's a real pleasure being here.
The tension between the US and China over trade is still unresolved after Trump announced steel tariffs in March. How do you think that this tension will culminate, and how will Australia be affected?
Really difficult to say, and I don't mean to be an economist that isn't giving a hard view, because it's unclear just what Trump is going to continue to progress with in terms of tariff increases in the US, and it's unclear whether China is going to retaliate further. So we just don't know. There seems to be elements of compromise, there's elements of raising the temperature, if you like, in the tariff debate, so it's not clear. What I think is clear, however, is that any move towards greater tariff protection, any retaliatory measures, are bad for global economic growth. They add to the cost pressure of various industries. There's a couple of little cute ones that popped up in the US in aluminium and steel that, Boeing, the fuselages and wings of the plane will be more expensive, so they lose their international competitiveness, for example. Or a tin of Budweiser beer will be 10 cents more because the aluminium in a tin of beer goes up. So there are some implications for the US that are own goals.
So there's a few things going on with the China-Australia relationship at the moment. There's high tension in the wake of Australia's crackdown on foreign meddling in domestic politics. Turnbull, among others, have expressed great concern about a Chinese military installation in Vanuatu. And China has huge national debt, but it's also Australia's largest trading partner. Where do you see the relationship headed, and what will the consequences be for Australia?
The relationship's been built up over 25 or 30 years, or even since Gough Whitlam visited China in 1972, I think it was, if I remember correctly. So there's been this long-established relationship that's served us remarkably well, that from taking almost none of our exports 20 or 30 years ago, they're now the dominant buyer of our commodities in particular, that we've ramped up this business investment in mining over the last decade and a half or thereabouts, and it's now yielding millions of tonnes of iron ore, coal, LNG, and now we're getting I guess you'd call it the second round spin-off of that with tourism and education exports of Chinese people visiting here, studying here. So that linkage is really, really important to us. It matters more to us than it does to China. So we want to keep that relationship strong, we want to keep it buoyant, not just for geopolitical issues, peace and all these other important things, but economically we don't want to upset the Chinese, because of course the consequences for us in terms of mining output, exports, foreign investment flows, tourism, these sorts of things would be catastrophic. So to the extent that the Chinese are putting ports in Vanuatu or the islands that they're building, we do need to assert our independence as a sovereign nation, but we do need to be careful, however, too, not to be overstepping the mark and offending the country that clearly is our largest trading partner.
We've had little progress in reducing unemployment in recent times, and we've got ongoing weakness in wages. We've also got a huge household debt at nearly 200%, with the Future Fund Chair Peter Costello saying in late March that the longer we put off raising our interest rate, the harder it's going to be for these households. What's your take on how Australia should be managing these pressure points?
It's been 7.5 years since the last rate hike, so I think I worked out the number the other day. There's been something like 3.9 million loans written since the interest rates were last increased. So there's a lot of people who have either refinanced or taken out a mortgage who have only confronted steady or falling interest rates. They're not familiar with what's a rate hike. They haven't had one for 7.5 years. And that's for all the reasons we just mentioned. The economy's had low inflation, low wages growth. It's been a bit sluggish with the mining investment downturn. So the RBA was managing that very issue. I think that the interest rate question is still heavily linked. This might sound a little old-fashioned, but just linked to the performance of the economy. I know it sounds a really silly thing to say, but the RBA have sort of been banging on about financial instability risks and all this other stuff, which I can understand, but at the end of the day, their job is to manage the economy with the inflation target between 2 and 3, and that's a target that they've missed for 2.5 years now on the downside. And even their own forecasts barely have it going back to the bottom of the target range in another year or two. So should we have, you only hike rates when the economy's strong.
The coalition was unsuccessful in securing the support it needed to cut the company tax rate, but it's still on the cards. The government says it'll make Australia more globally competitive, increase Australian investment, and boost wage growth. But critics say it's more skewed towards foreign investors. What do you think? To cut or not to cut?
I always like to see taxes lower, or as low as possible, but, and it's another important but, when they can be afforded and when other priorities have been funded. Now, if we had a significant budget surplus, if there was no real problem with the way that we're funding education, disability insurance schemes, public sector infrastructure spending, fine. I think that's actually a legitimate thing to lower the company tax rate. I think it's probably a good thing if you can do it. However, when I look at the numbers now, we've already got the budget coming up shortly. The budget is still in deficit. When Mr Morrison, the Treasurer, delivers the budget on the 8th of May, he will be delivering 12, or not him, they're not all his, but there will be 12 years of budget deficits. Now, not that there's anything wrong with that, because we've had a soft economy, we've had the GFC, and there's nothing wrong with that. But before you start delivering big company tax cuts, you'd want to at least see 1 or 2 years of the surplus locked in, I would have thought. So they're coming quite early in the cycle. They're a big amount of money, and perhaps there's other things that the money can be spent on. So I'd like to see, perhaps another, or just 1 or 2 years where the surplus is there before they were delivered. And the other thing to remember too is that as both, Mr Swan, Mr Hockey, and even Mr Morrison himself have found out as Treasurer, that the best projections for the return to surplus in a few years' time can be dashed with a little bit of bad news. We spoke of tariff wars or trade wars at the outset. Look, if that happens, if something like that happens and our commodity cycle turns lower, our export volumes take a hit lower, then all of a sudden that rosy outlook for the budget surplus disappears.
Thanks for your time, Stephen.
It's been an absolute pleasure. I've enjoyed it very much.